So, kia ora, nā mihi nui ki koutou katoa. Welcome to this special interview brought to you by Sharesies. As you may have heard recently, New Zealand Rural Land Company has announced a $20 million capital raise. And we'll be talking to New Zealand Rural Land Co. CEO Richard Milsom to get a better understanding about what's behind the capital raise and the company's aspirations. But first, we'd like to remind you of our legal disclaimer. Investing involves risk. You aren't guaranteed to make money, and you might lose the money you start with. Any information we provide is general only and current at the time. If you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider. Finally, Sharesies will be paid a fee from New Zealand Rural Land Co. for distributing the offer to Sharesies investors.
So kia ora, really great to be here. My name's Susanna.
And I'm John.
Cool. So now just a quick reminder, if you do have any questions, you can submit them through the Ask a Question button down below. Don't leave questions in the discussion area as they are likely to get missed. And if you need to leave or want to share this webinar, it will be available as a replay on the Sharesies YouTube channel later on.
Also, please be kind and respectful towards our speakers and your fellow viewers. Otherwise, we will take steps to remove you from the webinar. And with all of that housekeeping out of the way, welcome Richard.
Good morning, everyone. Thank you, Susanna, John, and everyone on the call. Really nice to be here with you all today and be able to talk about New Zealand Rural Land Company to those of you that may have been following the story for a little while, and to those of you that this might be a new company and just interested to see what we're about. So thank you very much for hosting today, guys.
Thank you, Richard. Yeah, we're really excited to have this chat. So let's start at the beginning. When and why did New Zealand Rural Land Co. get established?
So New Zealand Rural Land Company listed on the NZX in December 2020. So if you sort of think about that as being the start of 2021, we've been around for about 18 months. The green shoots of New Zealand Rural Land Company have been around for a long time. It's been something that we, and that's the group that run and govern New Zealand Rural Land Company at the moment, have been talking about for a very long time, and that was how to give everyone that wants the opportunity access to the agricultural rural sector in New Zealand. What we've seen for a long, long time is it's created a lot of wealth. It's the backbone of the New Zealand economy. Land price increases because New Zealand does have such a structurally competitive asset. You know, it is the lowest carbon footprint and the lowest cost producer of a whole variety of protein and crops on a global basis. And so that's been a really productive long-term asset for a lot of people, but it's largely been inaccessible because it's illiquid, meaning if you buy it, it's hard to sell. You can't just sell a portion of it. You need millions and millions of dollars to own a piece of rural land. And so what we've been discussing for quite some time was, how do we give New Zealanders access to that? How do we give them the opportunity to invest in a liquid manner? You know, if you want to put $10,000 into owning a piece of New Zealand rural land, you haven't been able to do that in the past. And you certainly haven't been able to buy another $1,000 worth or sell $1,000 worth and still retain the original investment. And so in sort of 2016, 2017, we got quite serious about working out what the right structure for this investment would be. Should it be listed? Should it be private? Should it be a wholesale syndicated investment? Do we want to operate farms? Would a better structure be to lease them out to tenants? What kind of tenants would we work with? When would be the optimal timing to get this sort of vehicle off the ground? And so for 5 years, really, that was being worked on quite expeditiously and thoroughly. We were provided with a reasonably good opportunity in 2017, where at the same time banks started withdrawing their credit from the sector. They lent a lot of money into agriculture and didn't want the same level of exposure they'd had in the past, and the foreigners weren't able to buy any longer. So there was an opportunity for a New Zealand-based buyer, like New Zealand Rural Land Company, to be able to buy assets at scale, lease them to New Zealand farmers, and buy them well. And so in December 2020, that all culminated with a listing on the NZX, and that's how we got our foundational start as a company. The group of people involved have a really good mix for this type of vehicle. There is a lot of investment and capital markets experience alongside a really deep agricultural and sustainability focus. Sarah Kennedy, one of our directors, was in charge of international farming at Fonterra for a long time. Sarah's a vet by training. Rob Campbell's had a long and storied history of both capital markets, agriculture in New Zealand, leasehold land interests, and a wide variety of implementation of sustainability initiatives in both private and public sector. Tia Greenway, one of our other directors, is on the Climate Commission and a director of a number of multi-partnership and agricultural ventures. And so there was a very strong group with a variety of interests and experience that all culminated in bringing this together.
Yeah, nice. And in a nutshell, for our viewers and listeners, can you describe just a bit more about how the New Zealand Rural Lanco business model, works in terms of how that operational model works and the commercials that follow?
Oh, sure. So at its core, New Zealand Rural Land Company buys land in New Zealand, rural land, and that might be anything from pastoral farms, so grass-based farms. That could be turning that grass into lamb, beef, could be planting some of those paddocks and crops, it could be turning that into milk. It will also be involved in time, I would imagine, in horticulture, forestry. A lot of these assets do have, you are provided, if you're patient, with very attractive times in the cycle to acquire, and we will be a patient and opportunistic acquirer of assets. And so at the moment, where we're seeing what we believe are the best risk-adjusted returns are in acquiring pastoral farms. And so we have built up a large portfolio of grass-based farms, about half of which are being used for dairy farming at the moment, and about half of which are being used for support farming, be it cropping or raising young animals. The key difference between New Zealand Rural Land Company and other types of agricultural investment that exist at the moment is we will own the land, and we will partner with a very experienced, well-capitalised tenant who's got a track record of very productive and sustainable methodology for going about their food production or their animal production. Secondly, our tenants need to have a strong track record, but also be signing up to binding commitments in their lease about the way they provide healthy, safe and warm environments for the people that work with them, that they adopt the 5 animal freedoms and emphasise that in their everyday. And so alongside different environmental initiatives, we've just been replacing some diesel pumps with solar pumps. We have a number of we have farm environmental plans per farm that are independently audited, and from everything through to water efficiency to the amount of fertiliser that's used. Because what we want to be doing is providing an opportunity for very able, quality and well-capitalised tenants to be able to grow and provide more equity growth and opportunity for people that work with them, like contract milkers, share milkers, equity partnerships, as well as provide New Zealanders and everybody that wants to own a piece of New Zealand rural land, the opportunity to be able to do so. And I mean, just looking at we tend to write on pastoral farms, and it's different for different asset classes, but we tend to write leases around that 5.5% mark. We saw that the value of our portfolio or our land increased by about 10.5%. Last year, we've gone out and signalled to the market that we think we're going to have a strong year this year as well. And so we think that by being signed up to very long-term leases with high-quality tenants that have a big balance sheet to support themselves with the volatility that you can sometimes see in the market, as well as people that treat their animals, people, and the environment well, is that we will have a very enduring long-term track with our partners, as well as providing people a liquid way to own one of New Zealand's, if not New Zealand's, best and most productive asset. So that's how we operate in a nutshell.
Great. And you touched on it earlier around that vision and purpose being around democratizing exposure to this particular investment class for everyone, and that you don't need millions of dollars to get exposure to that. Is that sort of very much still the vision and purpose today?
Oh, absolutely. It's to provide everyone with the ability to access an asset class that's typically been out of the reach of everyday investors like you or I, and also into a sector where people might want to grow but don't have $20 million to stump up every time they want to buy another big farm, is for established quality operators to continue to grow in the same way that you don't buy your building every time you want to grow your business. You need a partner, like a landlord, that's prepared to work with you, own the building, and you operate your business out of there. You're the expert in what you do, and they're the expert in what they do, and that's what this vehicle's designed to provide.
Thank you. And you talked a bit about growth, but what sort of growth has the company achieved since it began, or at least was listed around 18 months ago? And maybe if you could provide an example or two.
Sure. So we listed in December 2020 with $75 million. As at today, we've got approximately $260 million worth of assets and farms that we own to a variety of tenants. There's a lot of what we find very, very encouraging, because it has been our vision for quite some time, is we are seeing our register, i.e. the number of different people that are able to access this asset class grow. We've seen the performance of New Zealand Rural Land Company better than we anticipated. We said to the market that we would be aiming for 4.5% leases or greater. We've written leases at approximately 5.5% or greater. Rural land in New Zealand has done about 6.6% compounding annual growth just in the value of land over time. Last year we saw the properties that we bought do about 10.5%. We expect there to be a similar-ish number this year, as well as the rental income as well. And so in terms of growth of our portfolio, but growth in earnings for investors, we think both have been slightly better than we anticipated, and we would like to continue to be able to deliver that. I suppose the nuance or the slight difference with our leases they are inflation protected, and so our leases, when there is a lease review, they are matched to inflation, because farmers tend to be paid with a high correlation to the value of their lamb or their beef or their milk that they're selling. Then the inflation of their leases tends to match the inflation of the products that they're selling. And because there's a 3-year window before the next rent review, it gives that time to catch up. But what you would expect to see with this investment is and especially at the moment where shares are being offered in the rights issue and in the rights issue shortfall at $1.05 versus there's currently, and this is before this year's revaluation, there's $1.36 of net asset value per share. A different way of thinking about that is how much farmland do I own per share? You own $1.36 of farmland per share. You can buy it in this rights issue for $1.05 a share, and we're raising that money to fund 2 new acquisitions. I don't know a lot of other places you can buy land or buy property for 66 cents on the dollar with long-term leases signed, with quality tenants signed up.
Great, thanks, Richard. A couple of themes here I think we'll see a little bit more of in the questions around those inflation-linked leases and also that net asset value. So we'll come back to those later. But I'm keen to dive into the NZ Rural Lanco portfolio a little bit more. And so could you talk us through how the company goes through identifying assets to add to its portfolio and the types of things that you consider in those decisions? So like the quality of the tenants or any environmental, social and governance factors?
Yes, so if we have a look at, for us to, I'll work backwards from us being able to complete a successful transaction. So for us to complete a successful transaction, we need sort of 3 things to line up. We need to have a tenant that meets our quantitative and qualitative due diligence, which is reasonably thorough. And so if we put that in really simple terms, we need a tenant that's got the balance sheet, no different to the way a bank would look at you, a tenant that's got the balance sheet to be able to support a very long-term financial commitment. Secondly, we need a tenant that is going to be a good steward of the land, the animals, and the people that work with them, their employees. And so we need to see that both in a track record of what they've done in the past, their community involvement, their length and tenure of staff, how, what environmental initiatives they've been involved with in the past, whether it be retiring or restoration of wetlands and biodiversity, how their audits have gone, whether it be their shed audits or their farm environmental plan audits, their track record around animal welfare, what their internal policies look like, and then also in a forward-looking direction, what joint commitments New Zealand Rural Land Company and its tenants make on a go-forward basis. So any lease is going to have in it that the landlord and the tenant agree to pay the rent every month. Our leases go a lot further than that. There are a variety of quite strong and measurable commitments that both we and our quality tenants make to the industry leaders in the agriculture and rural sector in New Zealand, and that extends to, like I said, people, health and safety, animal welfare, the environment, the houses, the way people are treated, the way the environment's treated, and then that is all independently audited, and they're just as committed to that as they are to paying their rent each month, as our New Zealand Rural Land Company. And so we prioritise working with tenants that are that lean that way and consider that those core pillars of their business. So that's a long-winded answer to your question, but we need a tenant that we want to do business with. We need to find a quality asset or farm or piece of rural land that we like, and that we're able to buy it at attractive pricing. And thirdly, it's the outlook for the sector and for the asset class in general. And so those 3 things need to marry up for us to want to go and actually complete a transaction. We need a quality asset at a good price. We need to like the outlook for the sector versus the price we're paying for the asset. And we need a quality tenant that is prepared to partner with us for the long term.
Thanks, Richard. So following up on that, what would the current mix of assets in the company's portfolio look at? Like looking at idea of location or size or any gaps that might be there?
So currently what we own is pastoral farms. We own them in Canterbury, Otago and Southland. And so, if you think about the South Island, sort of the middle or upper middle of the South Island to the bottom of the South Island, we've got a lot of assets through there, diversified by region and by type. They are all pastoral farms, but they have a variety of some irrigated, some not irrigated, some that are used for support land, be it beef rearing, be it land grazing, some that are used for dairy farming, some that are used for rearing young dairy or beef cows, some that are used for genetic improvement, and some that are used for cropping. What we don't own at the moment, but we keep a watching brief on, is a number of the other asset classes within the rural space in New Zealand. So forestry, horticulture, sheep and beef farms. We also have some solar tenants that are interested in working with us. And so you might see some of our farms with some solar panels that are close to a grid. Other types of horticulture and orchardists like avocados, pears, apples, etc. What we're finding at the moment is we're seeing the best returns that we think we're able to generate in terms of the outlook for a sector, but also the price you're paying for something in pastoral farming. But we're always in due diligence and looking very strongly at other areas of the market that we're making an assessment on the outlook. We know that the quality of asset is there. New Zealand's got a very strong structural advantage across a variety of forestry, horticulture, etc. It just is a matter of outlook and pricing and tenants.
Yeah, thank you. That makes sense. So now turning to the $20 million capital raise announced earlier this month. Can you tell us firstly why you're raising the funds, and secondly how you're planning to deploy the proceeds?
We're raising the funds via a pro rata rights issue, which means that we're raising $20 million that is raised from existing shareholders in the proportion by which they own the company, so in even proportions to their current ownership. Any shareholders that don't wish to take up their rights, those surplus rights go into what's called a book build, and people are able to bid into that book build, and it sort of runs like an auction because the shares are being issued at such a discount to the value of the farms behind each share. If people aren't able to participate or don't want to participate in their rights, those are offered to other people, but other people bid for them, and any additional rights, any additional value that's achieved through that auction goes back to the shareholders that aren't participating. It doesn't come to the company. So that's the mechanism. And I see that Sharesies have actually written some very helpful how-to guides and explanation guides on how a rights issue and a book build works, which explains it a lot better than I could. But that's the best high level version I can give. Well, high level, low level, that's just the best version I can give. What are we raising the money for? We've found two farms that we really like, that trifecta of. So in terms of quality asset, quality purchasing, we think we're buying them well, and then new tenants, which increase our tenant portfolio and the diversity of our tenants.
Following up on that, Richard, how is New Zealand Rural Land Company funding the rest of the acquisition? I'm noting that the total purchase price for those farms is $29 million.
With debt. So we borrow money from Rabobank. They've been a long-standing partner in New Zealand Rural Land Company, and so we're raising just over $20 million, and there's about $9 million in debt that's used to fund the acquisitions as well.
Thank you. So New Zealand Rural Land Company released a market update earlier this month, touching on the current dairy environment and the release of the latest monetary policy statement by the Reserve Bank. Can you talk us through some of the key points from that update?
Yes, so the way that our leases are structured, and this is particularly with regard to the pastoral farms that we own, in the future with other asset classes, we might see more frequent smaller rent reviews, but as it stands, every 3 years, our tenants have a market, have an inflation adjustment to their rent. In the current environment, what we're seeing, and it's probably useful to go back a couple of steps, the driver of value to shareholders in New Zealand Rural Land Company is two pieces. The value of the land that they own going up, and the rental income they receive from our partners or our tenants, and that growing at the same percentage as inflation. And those are the two primary drivers of value for shareholders in New Zealand Rural Land Company. At regular intervals throughout the year, the Reserve Bank will put out its latest guidance and market observations. And the Reserve Bank's job is to keep inflation under control. So the Reserve Bank will put out a monetary policy statement, and it'll say, everybody, we think that inflation is, well, not we think, inflation is higher than where we would like it to be. The lever that we have to pull is to increase the OCR or interest rates. That increased interest cost to everybody, businesses and individuals, should decrease the amount of demand for goods and should pull back inflation to within the range we would like to see it in, and then we can lower interest rates again. And so the most recent monetary policy statement from the Reserve Bank came out and gave us a guide to two things, or the latest update on two things. It said, guys, we think that inflation is higher than we expected it to be, and it's obviously higher than where we would like it to be. And so the way that that impacts New Zealand Rural Land Company is that when our leases get renewed, when our leases have their market review take place, is there is 3 years worth of inflation that the leases get increased by, and that's a permanent adjustment. So over the next, we listed in 2020, if you imagine that each tenant or group of tenants you sign up each year, it's that year plus 3, they have a rent review. So the tenants we're signing up this year will have a review in 3 years. The tenants that signed up last year will have a review 3 years from then. So over those review periods, in those review periods, they will be subject to an inflationary adjustment. But luckily, we are in a period of very high income for those farmers as well. So their inflation adjustment on their leases is more than offset by very healthy income for the farmers themselves. The other thing that the monetary policy statement said is we think interest rates are going to have to be higher than we anticipated. And so the way that affects New Zealand Rural Land Company is in the short term, our interest bill is higher than we anticipated, but that is offset. That is more than offset by the increase to our income that we see by way of our lease increases. The third thing we said in our market announcement is to our investors and to the wider market is we had a very good year last year in terms of our the value of the assets we bought going up. We have said as we've bought assets, we believe we have bought them well. It's now coming to the end of the year and we've been able to see what the market's done for agricultural and rural land, and we think that we're going to have another very attractive year in terms of asset revaluation. And so at the moment, at our last valuation date, there was $1.36 per share that people are that we're issuing stock at $1.05 at the moment, or whatever people bid for it in the rights issue. That net asset value, or the amount of farm you own on it per share, is likely to go up in our view, and that's what we said in the market announcement as well. So to recap, our income is going up with inflation. that offsets an increase in our interest costs that will go up, bearing in mind that interest costs come back down. Our leases do not come back down. They are held where they are. And we also think we will have another very favourable year on the value of land that our investors own.
Thank you, Richard. And I might just ask one more question before we open up to the wider Q&A from the viewers that are tuning in. So, if you're looking at the outlook for the company and the wider sector for the next 12 months, could you tell us a bit about where you think the opportunities and the challenges are, and maybe how you're preparing to either make the most of those opportunities or sort of lean into those challenges?
I just missed that last little bit, Suse. There was just a little bit of crackle. Could you repeat the question, please? Sorry.
Yeah, sure. So sort of one last question from us, and that is around the outlook for the company and the wider environment, and in particular, what the opportunities and challenges you see over the next 12 months and how you're sort of preparing to face into those.
Oh, right. So from a company perspective, we continue to look for attractive opportunities. I think the other thing that we'll be doing is continuing to manage our growing portfolio, which is, our two key jobs as a company are to manage our existing assets and tenants very well, ensure that they're happy, that the assets are well looked after, that everyone, including us, is doing what they've said they'll do, and it's to continue to look at attractive, if they exist or otherwise sit on our hands, investment opportunities. In terms of the outlook for the wider sector, for quite some time there's been environmental regulatory changes. There are two primary bits that impact farming in relation to the environment. One is greenhouse gases and one is water quality. In terms of water quality, those changes in environmental regulations have been signalled for quite some time, and you have a high degree of, I guess, certainty and understanding when you're going in to buy a property. So you can look at the soil type, you can look at the irrigation, you can look at what the long-term carrying capacity of the land may be, not the short-term. You're able to do. There are very sophisticated tools you can use now around nutrient budgeting that says, how much can I put in without this affecting water quality around me, and therefore what can long-term production look like here, and can my tenant make a good living for themselves while still being very cognizant of reducing the impact on water quality around them. The second thing is e waka hekanoa, which is the partnership between the government, the industry bodies, which are Beef and Land, NZ Dairy, Horticulture New Zealand, and a lot of the scientific bodies, were a consortium, a joint plan to lower emissions from the agricultural sector in New Zealand. One of the issues that we face here is that although New Zealand is the lowest carbon footprint producer of a variety of protein in the world, is that we still, on an absolute or on a total basis, have quite high emissions for agriculture, because New Zealand feeds another 40 million people that don't live in New Zealand. The alternative to that is New Zealand doesn't produce that food and it gets produced somewhere else with a much higher footprint for that food. And so the challenge is for New Zealand to be able to produce food very efficiently and economically from an environmental perspective, but continue to lower those emissions and continue to get better every single day. And so we look at assets that are up to that, and we look at tenants that are up to that as well. And so that's how we're positioned there. And there are lots of tools, and you get plenty of foresight into the future. There's no, I suppose, shocks to come.
Great. Thanks, Richard. For the last 10 minutes, we're going to jump into the viewer questions, and I'm going to lead off with Joe, who is interested to know why climate risks do not appear in your investor portfolio offer document in the risk section, and asks, can you please explain why this is, especially if you are wanting a diversified land portfolio and capital being raised today is for dairy?
I just missed that last bit. Sorry, John.
All good. Can you please explain why this is, especially if you are wanting a diversified land portfolio and capital being raised today is for dairy?
Oh, yes. So in the risks portfolio of our presentation tends to deal with very immediate type of risks. What if a tenant can't pay? What if there's COVID tomorrow? How does this impact me? Climate change is certainly a risk. There's no two ways about that, but climate change tends to be a risk that will affect everybody, every industry, every person, every sector in the economy, both in New Zealand and worldwide. And so there are a number of risks like that. And if we touched on everyone, and of course they're important, but we would end up with quite an unwieldy risks section. When we're looking at climate change, we look at we assess as we're going through due diligence on a property that we're owning. We're considering two things in relationship to climate change. One is we're looking at is this farm more prone than other farms to risk of climate change? Is it coastal? Is it going to get flooded? Is it reliant on water from natural rainfall that's going to disappear? Or doesn't have irrigation, and so we make an assessment about its ability and its need for water, its soil type and its retention abilities, its risk of flooding in the future, etc. The other thing we make an assessment of in terms of climate change is, if we are the owner of this property with one of our tenant partners, are we going to have a more positive impact on climate change than if it was to trade hands to someone else? And so we have to make an assessment of what someone else looks like. So we look at the average of the region and the average of what the farm's done in the past. And if we can do, if under our ownership with our tenants, if we are able to do more or the same with less inputs, i.e. less greenhouse gas and less leaching, water quality wise, we believe we can have a positive impact on future climate change and water quality as an owner, as opposed to neutral or negative impact. And so we're looking at our assets in terms of their particular risk to climate change, and we won't buy something that we think has an above average risk. And we're looking at whether we can have a positive impact as an owner with our tenants on future climate change as well.
Thanks, Richard. Our next question is from Brendan, who says, I understand allied farmers help manage the leases, and follows up with, do you know how much cash they have put into this deal? And second, if you plan to manage the leases yourself in the future rather than outsourcing it?
So that's sort of right, and I understand where that's come from. So I'll just provide a little bit of clarity and colour around that. New Zealand Rural Land Company is externally managed. So rather than New Zealand Rural Land Company employing all its own staff, being property managers and due diligence consultants, etc., to keep the base costs at New Zealand Rural Land Company very low and ensure that there is that out of the lease that comes from tenants, there is a fixed cost for managing it, and the rest goes out as dividends to shareholders. Very similar to a lot of the other listed property companies listed on the NZX, it is New Zealand Rural Land Company is externally managed. That external management company is half owned by allied farmers, but in fact, they don't have anything to do with the day-to-day property management or finding of the properties. The manager or the external management company is in charge of all of that and charges New Zealand Rural Land Company a fixed fee of 0.5% of net asset value. So not on gross assets, but on net asset value, it charges 0.5% for that, and it is in charge of all the costs of staff, etc. And the benefit of that is when the company is small, when New Zealand Rural Land Company is small, it means that there is a fixed cost, and so dividends can come out straight away rather than having to employ 10 or 15 people at New Zealand Rural Land Company and get to a certain size before there is cash able to come out to shareholders.
Great. Thanks, Richard. One question here from Ella, who asks, I'm a young investor. Why should I be investing in this?
That's a tough one, Ella, because I don't know your personal financial situation, but I can tell you why I invest in New Zealand Rural Land Company, and I've just participated in the rights issue, and I bid into the book build myself to take up any rights that other people couldn't. So the reason that I invest in New Zealand Rural Land Company is I think that New Zealand rural land has a competitive advantage that is almost at no risk of ever going away. It is the lowest cost and lowest carbon footprint producer of food in the world, and it's very unlikely that that can or will ever change. It cannot get disintermediated by technology or by a change in tastes. The great thing about New Zealand is that it's sort of a Goldilocks country in the sense that it has just the right amount of sunshine out, just the right temperatures, just the right soil types, just the right amount of rainfall to be able to produce a variety of food very well. So if tastes were to change, you could be doing something else on a paddock versus what's being done there today. So you don't own an asset that only has one use. You know, it's not like worrying about electric vehicles versus internal combustion vehicles and buying a factory that only makes internal combustion vehicles. New Zealand is a factory that, for the lowest dollar cost and lowest carbon cost, can make a whole variety of food for the world, and I don't see that changing. And so I don't know anywhere else that you can buy such a long-term successful asset in such incremental amounts and have it liquid like it's traded on the NZX. And I definitely don't know anywhere that I can go and buy $1.36 worth of farmland for $1.05 at the moment. And so I was, excuse the pun, filling my gumboots.
Thanks, Richard. One more from Nixter, who asks, who comments around policies coming out from local and national government around freshwater as well as climate change, and as many of these restrictions will require significant investment / cost, and possibly desertification, land change use. And so he's wondering, are your leases responsible for meeting these, or are you? And how will you manage tenants wanting to quit a lease because of the cost / requirements of these? And if there's time, how sensitive are you to not getting tenants because of legislation changes that might come?
Okay, there's a few really good points in there, and I'll try and A, remember them, and B, get through them as quickly as I can. So, in terms of new legislation, the legislation isn't actually that new. There's long consultation periods, and you have a lot of insight into what is coming down the regulatory pipeline, and it is quite straightforward. There are areas where water quality is very poor, and there needs to be a dramatic reduction in the amount of nitrogen and phosphate used in those areas, and so that's a water quality issue. And there is also the Iwaka that I've touched on, that's to do with reducing greenhouse gases for farms. They're sophisticated tools, but they're simple to pull together in terms of being able to do nutrient budgets and greenhouse gas budgets for the farms that you're buying. You can look at the irrigation infrastructure and the efficiency, the soil types, the water quality in the area, the regulations that are coming down the pipeline, and you have a long, I guess, foresight in front of you. Not quite the right word, but you've got a lot of foresight into what is coming down the pipeline, and you can see that you're buying land that isn't a big leacher of nutrients. You've got a farming system that's going on there where there's a lot of bandwidth between what they're producing and what the actual law says, i.e. there's a big margin of safety in that, and so that does provide us with a lot of comfort, and tenants comfort in terms of what they're able to do in the future, how much bandwidth they've got between what they're proposing to do on there. The nice thing about a lot of farming in New Zealand is that the more productive you are, the more profitable you are, because you've got a lot less input and a lot less cost for the same output and therefore income. And at the same time, that's the more productive and the less inputs you use, the more environmentally friendly you are. So there isn't this natural tension between being environmentally friendly and being profitable. You can actually do both, and they are a very similar thing, all related to productivity. But on the land assets, for us and for our tenants, we've got a long runway to see what's coming down the barrel, and we are able to measure it and budget for it. There are certain areas that you would avoid. There are real hotspots where water quality is a real issue, and everyone's got to reduce their nutrient leaching a lot, and that's really going to curtail some farms. But you have insight into that, and that's areas that you wouldn't take the gamble and wouldn't touch, because there are such quality assets around the rest of the place. In terms of how our leases work, we don't warranty that the farms are suitable for their current purpose, and so that is a tenant risk. And then how do we ensure that tenants won't quit their lease? It's a legally binding document, and these tenants have big balance sheets or a lot of wealth supporting their leases, and so they can't just walk away from them. It's as simple as that. Although it would never get to that stage. Our tenants are our partners. We do due diligence on the properties together. Neither of us would enter into something if we thought there was a risk element. We just walk away.
Great. Thanks, Richard. It's 1 o'clock now, so we're going to have to wrap up the Q&A and the special webinar. Thanks to everyone for being really engaged in the Ask a Question section. And also thanks so much to you, Richard, for joining us and taking the time to talk about New Zealand Rural Land Company. My pleasure. Thank you.
Yeah, thanks, Richard. We have really, really enjoyed it. And thank you to everyone who's tuned in today. And remember that this will be available on the Sharesies YouTube channel.
See ya.
Cool. Ka kite.